Whiteboard podcast, episode 3 this week. I'm here as always with my co-host Brady. What's up, fam? And then our director, Tyler, director/producer. Can we give you both of those? This week we're talking about captives, high deductible programs when it comes to workers' compensation. We talk about the difference between WCIRB audits as well as payroll audits. And then we have a sob story from one of our clients, which sounds like we're trivializing. It sucks. It really does. But it's a really good podcast, guys. So let's get to it. Why are you laughing? What are you talking about?
I didn't say anything.
Dude, what's going on? Yeah, tell me about it.
I'm just talking to myself.
What are you talking about? Ready? 5, 4, 3, 2, and we're live. Episode 3, guys. We're doing it. I want to start this podcast off. Over the past 2 weeks, I've ran into 2 or 3 companies that have premiums up over $750,000. And they're all guaranteed cost, and that is a very, very big trigger in regards to start looking at alternatives outside of the guaranteed cost. And so while the experience modification won't have the same impact if you're in a self-insured or high deductible plan or even captive, it still is a good temperature monitor on how you're performing in regards to your work comp claims and your data. So to start, we're going to go over self-insured, what that actually means. Self-insured groups are no longer allowed here in California. That happened back in 2012, I think, with BBSI being self-insured. They had, I think, $120 million of unfunded reserves, something like that, crazy. And so the Department of Insurance stepped in and said, hey, no longer allowed to do self-insured. So the PEO actually had to go get their own reinsurance, which I believe was Great American. So they have a $5 million deductible. So for any individual companies out there, do you have questions, Brady?
Yeah, we have a lot of people tell us on the phone that they are self-insured. So what do they mean? They mean
they have a deductible.
Okay.
The problem is some of these terms, depending on whether you're talking about, work comp or even health insurance, they mean different things. So self-insured is the best way to look at it. It's just a large deductible is when you're hearing that on the phone.
Okay.
And that can either be a per claim deductible or an aggregate deductible. And typically you'll see those from anywhere from about $25,000 per claim up to $500,000 per claim. And then an aggregate right around $500,000 or aggregate up to, I haven't seen a $5 million one. That would be crazy. So what that means is per claim, your max out of pocket is going to be X, which would be $25,000. If you have an aggregate, and that's $500,000, if you have, what would that be? 4 times 5, 20 claims. If you have 20 claims that hit your $25,000 per claim, which means you've hit $25,000, it does not matter if anything over that $25,000 goes into that $500,000 pool because that's already getting picked up by insurance. So what that does is allows the company to take on a lot more risk on the front end when it comes to that first $25,000 and minimize their exposure on the back end, saying, hey, the max we're going to pay for this year, regardless of how many claims we're going to have, is $500,000. And so for a lot of companies that have over $750,000 in premium, this type of insurance start making a lot more sense than, a guaranteed cost at, first dollar.
Right.
So the next piece that we run into a fair amount is folks that are in captives. There's a few different type of captives. Typically they're all created out of, I think, Bermuda, like offshore. They have weird rules and stuff, but you can still have an admitted captive here in California. And so what that actually is, it's an insured, so a company can either have their own captive, so a single parent captive, or a group captive. And captive is just another word for an insurance company. And so all they're doing, which we'll go to a slide here, explaining exactly what a captive is. So employer pays insurance premiums to a carrier, which is themselves essentially. So let's say you have a group of 10 employers and they all pay in roughly $500,000 into this captive. Captives can sometimes have per claim deductibles, same structure, kind of self-insurance. But what'll happen is the insureds pay into the captive. This payment is going to pay for losses and administration. So for like a TPA, a third-party administrator managing their claims. And all that happens during that time is any claims that come in from a work comp perspective, the captive will pay out those claims. And based on your performance, that's how you're going to be rated on next year through the captive. Because what they don't want, again, if you're in a group with 10 other employers, is they don't want one person ballooning the entire captive's loss ratio and putting the entire captive in jeopardy. So that people can get kicked out of captives if they don't perform well. But typically, if you have the cash to do it, and this requires a lot of upfront capital, because you have to have two things. One, you have to have capital to pay for the claims. And then two, you have to have reinsurance, which is essentially what will sit on top of whatever cost that the captive is going to incur. And that can be anywhere from, $1 million up to $5 million. Typically doesn't run too much farther past that unless you get up to, very, very large clients. So what'll happen is client pays into the captive. From there, it goes into all the losses, and claims are paid from that captive as they occur. And so if you run at a surplus, meaning if the captive's not paying out any claims, or just whatever the difference between what they're paying out less the admin fee, what gets to happen is that money can go sit and actually accrue interest. So a lot of the captives that I've seen, what'll happen is they might have over 5 or 6 years a few $1 million in an account that's getting 3 or 4% interest, pretty much guaranteed, that if they need to dip into it to pay for claims, they can. But for any of those great years, they get to capitalize on the difference between what's been paid out and what they've actually put into it. And so all the members of the captive will give it essentially what's like a dividend check back, depending on what the members vote on.
Yeah, I saw online there was another slide about when you're in the guaranteed cost plans, that money obviously stays with your insurance carrier. When you're in a captive, up to like 85% of that money set aside can be paid back out as dividends. So I guess 15 goes to the TPAs or whatever, the things that you have to pay for, but then there's still that 85% out there for you to get back if you have good loss history.
Yeah. So I get this question a ton from clients, and they might have, $150,000 in premiums or roughly somewhere around that. Like, well, can we do a captive? Problem is, like, they can. It's just the upfront capital or line of credit they have to get is usually will limit them from jumping into that boat. Right. So it is frustrating for a lot of business owners. I mean, 98% of, business owners aren't in a captive. And so what sucks about that is you might go 10 years and you don't have a claim, and you've paid $100,000 a year into that premium. And so let's say you're with AmTrust, you've just paid AmTrust $1 million over 10 years and got a very, very expensive piece of paper in return. Never had a claim. So I could really, really do understand all these business owners like, man, if I just would have paid these out and just paid myself into some sort of fund, I would have been able to fund my losses, over the last 20 years and have $1 million left over.
So can a bunch of small companies combine and make a captive? Can they come up with that capital together?
Yeah, they definitely can, but it's hard to get a bunch of business owners who are operating, in a homogenous nature, right? So if you were someone who lays flooring, you probably wouldn't want someone who does roofing in your captive, right? Mm-hmm. The reason why is for flooring, you're going to get a lot of lower back strains, like soft tissue stuff. With roofing, if someone's not wearing their PPE, they fall off the roof and fall protection. Mm-hmm. Well, now you have $1 million claim on your hands. So what's difficult about that is getting a bunch of, 20 to 30 to 50 like-minded companies who have an emphasis on, safety, to all play the same game, understand how the claim reporting works. And that's tough to do. So it's definitely possible. Mm-hmm. You
just got to find the right people.
I know. So the alternative to that is like a PEO, which smaller companies can jump into. So essentially, PEO is a professional employer organization, and all that is allows you to put your employees under what's called a co-employment agreement with the PEO. The PEO itself will take out a large deductible on any one claim and then have reinsurance over that. They might have a deductible too per claim for the client, but that's the best way for a small company to really jump in. And so while the savings can be great from having a guaranteed cost to PEO, you're still not capitalizing on, the underwriting profit that you might receive in a captive.
Right.
So yeah, there's just a big donut hole for companies that haven't had many claims, but don't have enough to capitalize on a captive, so they go with PEOs, and sometimes that's cheaper too.
Makes sense.
Yeah. So one of the problems with captives, and we ran into this with one of our lumber manufacturers, is they were in a captive, and that captive did not report any of the claims to the WCIRB, which is the Work Comp Insurance Rating Bureau. And so for an entire year, I think they had one or two claims, like very minimal, I think less than $10,000 in claims cost. And so all that payroll never got reported to the WCIRB. So what happened is they had 2 bad years. The year that they were in the captive was great. They didn't get credit for that great year. So their experience mod ballooned up 40 points, not because they didn't perform well, but because they didn't get to capitalize on the premium to loss ratio that would make their mod go lower. And so that's why it's important, if you are in a captive or have been in a captive, to see if the WCIRB will make an exception for us to actually report those claims under the employer's FEIN. So
Usually they don't.
No, they don't have to. Yeah. So that's part of the problem is some of these captive companies are like very, very, run by 3 or 4 people. And so, they might not be admitted in the state. There's a whole bunch of reasons why it might not go into the WCIRB. But one of the processes that we do is that Workers' Compensation Insurance Rating Bureau audit. And so maybe you want to touch on that, Brady, because there's 2 different things when we say like work comp audit, right?
Yeah, as a caller, we'll reach out to people and we tell them part of our process is to do this audit, and they go, we already had our audit. And 99% of the time, probably a little bit higher, they're talking about a payroll audit, because everybody does a payroll audit at the end of the year. You report your payroll at the beginning, and then you go back and make sure that it was what you predicted it to be. They clean up, one way or the other. But what we do is a reverse audit on the rating bureau. So we're going back for those 3 years in your loss period, and we're going to look over the 43 different data points that they actually use to calculate your mod. So any errors, any, a line item entered twice, an extra 0 somewhere, something that went unreported like you were talking about, those get fixed. The rating bureau is usually pretty good. They change it within a week or 2. And then the client, whoever the company is that had that error, gets reimbursements from past carriers as well. So
let's use an example here. So let's say there's a duplicate claim that happened in 2017, and we go to the WCIRB, say, hey, Tommy is in here twice for the same claim. They're both $10,000. This looks like it was double reported. What's the process in regards to getting that fixed, and then how does that work in reimbursements of premiums?
Specifically for that one, the adjusters would have to fix and file that either as a joint claim or notify that it was the same claim entered twice.
Yep.
Then we take that to the rating bureau, so the WCIRB will take a look at it. Last time we did that, we just had one kind of like that recently. It took them less than a week, and then we got a notification from their service to our email saying that a mod change has happened.
Yep.
And then they have a re-rate for all the years that claim was on their loss history. So,
which is a big deal.
Depending on how old it is, it could affect 3 years for them.
And that's part of the magic, going back 3 years. It allows us to retroactively change their experience mod. And what's cool about that is typically when companies underwrite an account, they take the base premium, they multiply it by their experience mod. So let's say if someone's paying $100,000 and they have a 2.0 experience mod, their premium goes up to $200,000. And then because the underwriter wants to get competitive in regards to writing that account, they'll include premium discounts and scheduled credits of maybe up to 40%. And so if someone gets a 40% credit on $200,000, that's $80,000. Premium goes down to $120,000. However, let's say we make a large adjustment on their mod because of a couple errors, and their mod goes down to $150,000. Well, now it's $150,000, and you still get those 40% scheduled credits and discounts, which would be $60,000. So you'd pay $90,000. So you get $30,000 back,
right?
Which is substantial. And what's nice about that is if it's made in 2017, because of the way the experience mod works on a rolling 3-year average, it's not just going to impact you for your current year. It'll impact you for 2017, 2018, 2019, which is a really, really big deal. And it might impact your current rates too, depending on how and when your rating period is.
And sometimes it takes a while for the carriers to actually make those reimbursements. The one that we did was probably somewhere between 3 and 5 weeks ago at this point, and they re-rated it fast, but then the carriers have been slow to actually pay it out. But
I bet they are.
It's
it makes sense. We had one of our larger clients, I think we got back $110,000 from ICW. And the change was made in June, I believe. And they just assessed whatever they were owed because they've been with them for 5 years at audit. So it literally took about 7 or 8 months, because it was a January 1st renewal, to get that money. So it kind of sucks. But at the end of the day, like if that mod is changed, what's nice about that is it's retroactive.
Right.
So if you have an experienced modification change and it's in your favor, it's always retroactive to the policy date of inception. If it's not in your favor, then it's prorated, meaning that if, let's say, they made a mistake and your mod has to go up 5 points and it's 6 months into your policy term, they're not going to go all the way back to inception.
You only paid for those next 6 months.
Correct. Yeah. So that's a big thing to remember, is that when we find errors that aren't in our client's favor, we're under no obligation to share that with the WCIRB, which we do find quite often.
Yeah.
You know, which sucks when they pick it up, but if they don't, like, bank error in your favor, collect however much that is. So it's a really good thing. Do you have anything else to say on?
Nope.
Okay.
That's the end of that one.
Yeah. That's that's something that most companies just won't understand unless you get in there and talk to them exactly what goes into the rating period. And it sucks because if a company gets blindsided by a high mod, they can be in a very, very weird spot when it comes to, you know, their work comp premiums and then just their cost of labor is going up. So something that happened this week is we had one of our clients write our partner Jeff, it was one of his clients, an email, and they were talking about how they have to go out of business, which it's part of the reason why we started this company is like we saw companies go out of business left and right for this issue, not because they didn't have the right safety practices, not because they didn't care about their employees, not for any of those reasons other than, you know, they had a few claims, and because of the way the X mod works, it put them upside down on their cash flow and they had to go out of business. So I wanted to read this email that we got from a client, and I'm going to use some anonymity. Is that a word?
It is now.
It is now. Yeah, so I'm not going to say who the client is, but Jeff got this email. It says, "Good afternoon. Please be advised that client name is closing its doors effective immediately. We have spent the better half of the last 6 months analyzing each account to ensure we are charging appropriately. We have sent out the necessary increases in order to cover our operating expenses, and unfortunately we have not received the reception we are hoping from our clients. The yearly increased costs in minimum wage, taxes, insurance, fuel, materials, etc. has made it difficult to make a profit in the janitorial industry anymore. I wish we would have met Whiteboard a couple years ago before we ended up with such outrageous workers' compensation rates. Please let us know if you need anything else in writing. Thank you." So it's these kind of emails that's happened twice in our 5.5-year history that legitimately break my heart. This company, I think, had 50 employees. Like Jeff said, been
around for a while too, right?
Almost 20 years, 18 years. So they're 50 employees, and they closed their doors effectively. When 50 people were out of the job, the owners and the management team, who were really, really good people and cared a ton about their business, now have to shut down their doors. And that's the kind of stuff that, like, when we help a company not do that, which we've gotten those emails too, like, hey, if we didn't come in and solve this problem, I know at least 3 companies that have sent us emails explicitly saying, hey, like, you're the reason we're still in business. Mm-hmm. That is something that makes your day. And then something like this is, it sucks. It's really, really sad. And I think, especially here in California, because it is the most litigious state, and because, probably don't want to get into politics, but because wages are increasing, because litigation rates are increasing, because the pendulum has swung so far in the employee's favor, it's very difficult to do business here, especially in a blue collar capacity, because, you know, there's a ton of businesses that are competitive, and a new one pops up and they don't have those increased, you know, labor costs when it comes to workers' compensation, or they just don't have work comp. There's some dirtbag janitorial company that's just, hey, we're not going to do it, which there's tons of companies out there that just don't have work comp, and they just fly under the radar, and, you know, they get caught and then they reorganize and start a new one. But it's the legitimate companies that are doing everything right that are getting burned. And so I see in the future a lot of businesses and entrepreneurs moving out of California because it is just the opposite of a business-friendly state, which sucks. Mm-hmm. So it's these type of emails that like, I sent this out to everybody yesterday and let them know like, hey, the problem we're solving is a massive one. And this is serious business. Like families are depending on us to do our job well. And you could say that that's, I don't know, what's the right word? You could say that that's a little bit sensational in saying that families depend on us, but like it's real. Yeah. It's very, very real. Like 50 employees lost their job, and that sucks. So that's probably one of the best warnings to business owners listening to this podcast is like, this can happen to you at any time. You have to keep your finger on the pulse when it comes to cash flow. You have to understand that like wages are rising by 2022, I believe. Every single business has to have pay their employees at least $15 an hour. By June or July this year of 2020, they have to have a retirement plan sponsored by the company. If they don't, they go into Cal Savers, which is a retirement plan sponsored by the state, and that requires 5% of the employee's wages to go into that. Now, the employee can opt out of that, but if they don't, like, it's still a burden. And if one of our clients doesn't do that, they can get fined, I think, $250 per employee that doesn't enroll. Well, it doesn't sound like a lot. If you have 100 employees, that's $25,000, I think. I hope that's right. $25,000, and that's kind of stuff that like can just sneak up on you. You know, a lot of folks don't have like those kind of expenses. Another thing that happened was one of our clients, one of our best ones. They had, I think, 32 auto claims over the past 2 years, 18 of which was not their fault. So the majority of these aren't their fault, and their auto premiums went from $160 to $660. So legitimately, almost $500,000, this thing went up, and it sucks. And coming in with like a renewal like that is like, it's heartbreaking. Because like, oh, well, you know, their raises aren't going to happen. The owner's probably going to have to pull money out of his own pocket to like put into the business so he can sustain. And this company has over 130 employees. It's those type of things that like, if you are not keeping your finger on the pulse, like you are in deep doo-doo. So that's another good thing to look at is like insurance costs. And this is why it's so important to empathize with our clients is like they pay a ton of money for like a piece of paper. And if that piece of paper isn't responding how the contract's supposed to read and they don't have someone in their corner fighting for them, they can go upside down really, really quick. And it sucks. But that's probably the darkest note you could end a podcast on. So maybe we jump into what we can do to help on all those fronts. So Brady, you do some onboarding, or you've done some onboarding before. We have Chris doing that now. We go through our entire service portfolio, not to, say how sick we are, but like there are, probably 30 different resources that we have that will help them insure their uninsurable risk. And that means managing their employees more effectively, start making your case against your employees before they even have an injury. And you have to do all that kind of stuff. You have to protect the business. The business is the thing that keeps the lights on. It pays the bills. It pays for raises. It pays all those things. And so, like our service portfolio is not just like, we don't want to be your insurance broker. Our job is to be a resource platform for your business and function as an independent broker, which means we're going to go out to every single carrier that can write your account, leverage and negotiate the best rates on your behalf, and make sure that you're in the best spot. And then on the other side is like you have a whole bunch of risks that are walking around your office every single day that could ultimately take you under. And that's from like a wage and hour claim, a sexual harassment claim, wrongful termination, workers' compensation. You could have a lot of auto claims. Like all those things happen, OSHA can come in and fine you. The EDD can come in and fine you. Like they're looking and they're sharks are coming after it. So it is important. If you're one of our clients listening to this, please utilize our resources. They're there for you. They're really, really valuable. And, a lot of our clients don't have a full-time risk manager on their team, but our job is to function as a virtual risk manager. Mm-hmm. So for all the things that can come in your business, like you need to be aware of, and you need to understand how to walk through that minefield effectively here in California.
Makes sense.
You feel me, dog?
I feel it.
Okay. Let's do it, guys. Hey, thank you for listening in. We really appreciate it. And we'll see you in a couple weeks.
Peace.
Peace.